Hey everyone, welcome. Thank you for watching. Thank you for subscribing. As I mentioned in the intro video for this channel, subscribe to my channel. I really don't care. I'm not trying to sell you anything here, so I really don't care. What I am trying to do though is teach each and every one of you how to properly underwrite commercial real estate deals and just how to be a better commercial real estate investor or property manager or broker and share some best practices. So in this video, I just want to talk about real estate taxes and how you reassess them. So when you buy a property, the real estate assessor is going to probably increase your appraised value or your assessed value, and you need to know how to calculate that so you know how much more or less your taxes are going to be. Now, there's a couple of ways that you can do that. Let me show you the worst way, and I'm gonna kind of go through this. But first up, go to the property appraiser's website. Go pull last year's tax bill on the property that you're looking at. I think that most municipalities throughout the country have everything online. So go there, pull it, and look. This particular property, I changed the city to Anytown, USA. So here we are. This is the city taxes. They have a river water management district. They have some other ancillary stuff that I kind of deleted. They also have school, discretionary. They have capital outlay and local. All of these millage rates adds up to about 17 mills. So then you take the millage rate times whatever the assessed value for the property is. In this case, 10.8 million. That was what the appraised assessed value was according to the county last year. You take the assessed value times the millage rate. So in this cell, what I've done is I've taken the assessed value times the millage rate for that, and it's $122,000 a year. That comes out to $1.48 per square foot on this particular property. You copy that cell all the way down, and the total ad valorem taxes that they paid last year was $184,000 or $2.23 a square foot. There were also some non-ad valorem assessments. These are usually minor assessments that are not tied to the assessed value. There is no millage rates for these. It's just a flat fee. And in this case, there was a stormwater non-ad valorem assessment of $3,700. So the total real estate taxes for this property was $188,000. Now, is it important to separate all this out? Not really for a small private investor, but if you're doing anything over, call it $5 million, I do, and I'll tell you why in a little bit. But going back to how you reassess this, the worst way that you could do it is just say, okay, well, last year it was $188,000, so this year, let's just say $188,000 or $184,000 in non-ad valorem taxes, and let's just increase this by 3% each year. So each of these is just increasing by 3%, or inflation or whatever you want to use for inflation. So over a total of 10 years, you'll pay, a total of $2.365 million. It's the worst thing that you could do. It's the dumbest way to do it. But I see a lot of people doing it. Here's a better way to do it. Here's a way where you say, listen, we think that we're going to buy this property for $7.5 million. That's what I'm targeting for this particular property. A typical reassessment percentage is 90%, okay? 90% of the value that you buy it for is typical in this particular municipality of what they're going to reassess it at. Now, your municipality may be different. They may reassess everything at 80%. They may reassess everything at 100%. You need to find out. So if we buy it for $7.5 million, the reassessment rate at 90% is going to give the property county tax appraiser a $6.75 dollar value for the new assessed value. Now, that's actually good news. That's a lot lower than what it's assessed at right now. So if we keep the same exact millage rates next year as they are this year, which I'll get to in a minute, but if I keep the exact same millage rate and apply it to my new reassessed value, my taxes are going to go down quite a bit. They're actually going to decrease from $188,000 to $118,000. That's not bad. That's good news. So in the other example that I had said where you just kind of increase it at 3%, I'm doing a heck of a lot better. So now I'm at $114,000. And if I increase that by 3%, I'm going up to I'm totaling like $1.4 million. So that's pretty good. That's a lot better. Now, what are some other things that I can do? In this particular county, one of the things that you can do is you can go back and get historical tax documents. You can see what the previous 10 years of taxes have been. So that's exactly what I did in this with this particular property. I went back 10 years to 2013, and I pulled every single record for the real estate taxes. First thing that I looked at was the assessed values in each of these years. So here's the assessed values running down from 2013 to 2022. Then I looked at the percentage change of the assessed value, and it was really kind of weird. It was funky. The first year it increased 10%, another 10%, 10%, then it only increased 2.3%, then 9%, down 5%. So it's really weird. It's kind of all over the place. What this kind of tells me is that the owner had no clue what they were doing, and they never hired a tax consultant to go fight for them with accounting. But anyway, that's their problem, not mine. But what I'm doing here is I'm looking at the average percentage change. So in this particular case, on average, the county increased the assessed value by 6.72% each year. Okay. So now what I'm going to do in this column is I'm going to say, okay, my new assessed value, $6.75 million, I'm getting that from this, the proposed purchase price times 90%, $6.75 million. And I'm just basically going to increase that by 6.7%, which is the average increase that they've had over the last 10 years. I'm going to increase that by 6.7%, 6.7, 6.7. So each year, the assessed value is going to go up by 6.7%. Now, millage rate. Millage rate has been a little bit different as well. I created a graph, seen here, of the millage rate. The millage rate has actually gone down over the last 10 years, and we're kind of at an all-time low. So from here, I'm trying to figure out where I'm making assumptions, right? I'm guessing as to where the millage rate is going to go. I'm making assumptions as to where the assessed value is going to go, and I'm making assumptions as to where the millage rate is going to go. Is it prudent to think that the millage rate is going to continue to decline forever? Probably not. So what I've done is simply said, you know what? The average here, I'm just kind of guessing that the average from 17 to 19, it's around this 18 range. That's kind of the average. So over the next 10 years, let's just kind of model this so that it gradually increases back to the mean. It reverts to the mean. And so that's what this is. This is your millage rate today, and then I'm basically just increasing it over 10 years so that it gets to around 18 mils. So now what we have is a future forecast, 10 years of assessed values and millage rates. From there, I can pretty much just multiply my millage rate or my millage rate times my assessed value to get my ad valorem taxes for that year, run that out 10 years, and then now I'm at 1.6 million. As you recall, one of the better method was at 1.4. A little bit more accurate is about 1.6. I would probably keep the non-ad valorem taxes at about the same, $3,700. I might increase that, by 3% a year or something like that, just so that I've got some room in there for increases. But from here, once I have these numbers, What I do is I actually transfer those into Argus. Now, if you aren't familiar with Argus or you're not using Argus, that's okay. Don't worry about it. But if you are using Argus, these are the exact numbers that I plug into Argus for that. The other thing that I noticed that I'll at least mention is in this particular county, and I'm sure there's other counties across the country that are very similar. Sometimes they will have two different assessed values. They will have the standard assessed value, but then they'll also say the school's assessed value is different. And I have no idea what methodology they use, but if you notice down here, there's three separate millage rates for school discretionary, school capital outlay, and then school local. So a little bit different millage rates, and whatever they're using over here to get to a different assessed value, I have no idea. Some years it's exactly the same. This year is 6.105. Both the values are the same. I only point this out because I think it's important to know and understand, but for modeling purposes, it wasn't a big enough difference to really move the needle. Now, earlier I had mentioned, is it necessary to break all these out and do this level of analysis? If you're a smaller investor, probably not. I would do this if I bought a duplex, I would do this just because I'm that anal, right? But the reason that you do it like this is so that when you are hopefully your property manager is astute enough to recognize that if they were to enter their buildings into BOMA or into the Toby Awards or try to get your building to shine, right? They're going to need to understand this. They're going to need to say one of the items is, what is this building's impact on the built environment? What does this building do to contribute to society, basically? And this is a perfect way that you can break this down. You can create pie charts and say, look, my building contributes $122,000 to the city. We contribute, all of this money to the school system. This helped buy books. This helped educate kids. So is it necessary? No. Is it a step further than everybody else is going? It sure is. And so again, the entire purpose of these videos is to elevate our industry, to make everybody understand absolute best practices. So this is how I do it. I'm very, very curious to see how you all are doing it. I'm trying to see if there's a different way, a better way, and what you all think. So I appreciate you listening. I appreciate you watching, and look forward to your feedback, and look forward to seeing you on another podcast.